Just a brief introduction to the team. Obviously myself, Paul Hogarth, Chief Exec. On my left, I've got Paul Edwards, our Chief Financial Officer, and on my right, Lothar Mentel, our Chief Investment Officer and CEO of the Tatton Asset Management business. Just a quick review on slide 6 of our divisional structure, just for the new people on the list. Obviously, you've got 2 divisions. The investment management piece, which is the Tatton DFM MPS service, which is growing nicely and has grown obviously over the last 10 years. We've got our 10th anniversary in January 2023, competitively priced at 15 basis points and working in line with all of the IFAs within the UK IFA wealth management arena. On the right-hand side, you've got the IFA support services business, which is basically Paradigm Consulting, which is the IFA support services bit, and Paradigm Mortgages, which is our mortgage club. And all of the membership in there are directly authorised, so we have no responsibility for their errors and omissions, and we consult with them to keep them on the right side of the track with regards to regulation. More on that later. So if we could move over to slide 7, please, which is slide 8, which is the key highlights. Obviously, really pleased with the last 6 months. It's amazing, really, what we've achieved in what are very difficult circumstances. Our flows are record-breaking. We've been actually growing at 150 million a month, so 907 million of new money, which is fantastic. And also, we've done really well on the mortgage side as well, with record number of completions. So that's reflected, obviously, an increase in revenue and profitability, which we're delighted with, and the progressive interim dividend announcements of 4.5p payable in December the 16th, up 12.5%. But our key metric is very much about the AUM, and we've added in the AUI, and the AUI is for the 50% purchase of the Tatton Asset Management business that we've concluded. So now, or as at the end of September, we're 12.3 billion, which we're obviously delighted with. And I'm happy to say that those flows, positive flow rates, have continued as well into October and November. So if we do look at the number now, we're actually sitting at 12.9 billion. So, an exemplary set of numbers. If we can move on to operational on slide 9, we can see that not only have we got those great organic flows, but we're actually seeing flows coming from one of our newish strategic partnership arrangements with Fintel, which is just coming up to its first anniversary. And we've got 300 million from the Fintel firms, from a standing start, which we're very pleased with. Further, an increased IFA engagement. I think that comes down to the fact that the MPS world is just growing it with maturity. If you look at any of the other asset management businesses, the only place that they're growing is MPS. And of course, with us being the market leader there, we're getting our fair share of the spoils. We've probably got about 13.9% of the DFM MPS market, and we obviously want to at least maintain that and grow that if we can. So actually, we've got over 806 IFA firms supporting us on a weekly, monthly basis. That's up 14.7%, and reflected in the number of accounts, which now stand up over 100,000 accounts. So you can do the maths to work out roughly where we sit. It's around about 130,000 per account that we have, showing that we're bringing DFM to the masses, really. So very much the quest that we set out to do is coming to pass. And happy to say, as I say, that the mortgage business and Paradigm Consulting have done their share as well, maintaining their position and having those record completions, which give us this stunning 6 months performance. And we'll have a good look at the mortgage market, because obviously we don't expect that market to actually continue at that kind of level. It's likely to come off, and we'll talk about that shortly, so you can see what our thoughts are on that. But it's only sort of 10% of our total revenue, so we certainly don't expect any sort of real changes to our numbers, and it won't push us away from our numbers that we've been forecasting. So that's, as I say, good report. If we move on to slide 10, basically our little bragging slide. But what we're showing there, that despite all the chaos from March 2020, and my goodness, there's been plenty of that, we've grown our AUM from 7 billion to the 12.9 in 2.5 years. So testament to the model, testament to the business, testament to the consistent investment returns that we have, and also testament to the way the MPS world has matured. I'll pass you over now to Paul, who'll take you through the numbers in greater detail.
Good morning, everybody. The last 6 months have been a really tough market, I think for most businesses, but specifically in the wealth management sector. So, everything in life is relative, and so consequently, we're delighted to see our revenue grow by 15%, clearly supported by increasing AUM over that period, and specifically those record flows Paul referred to in the highlights of 907 million. In typical wealth management sector or fund management sector, you'll have seen, businesses be affected by both, redemptions, but also negative markets as well. And we can't necessarily escape negative markets, but our flows have been very strong. And then add to that the record mortgage completions as well. That's what's been driving that top line. And obviously we're in an inflationary environment, but we're also delighted to see our adjusted operating profit increase at the same rate and maintain our margin at over that 50%, which is a number that we're looking to maintain as we look forward as well. We're confident in that. We've got our normal standard adjusting items of share-based payments, amortization, sort of non-cash amortization, and then the exceptional items which relate to the acquisition of 8am just before the interim period end. But what I'd probably sort of highlight there is the adjusted fully diluted earnings per share. That's up just under 13%. The first 50% of the acquisition cost of 8am was a placing of 1.1 million shares, and so that's why the growth rate is slightly lower than the adjusted operating profit. And as Paul said earlier, we've just declared a dividend of 4.5p. And when you go back over the last 5 years, we've consistently grown our dividend in the same rate as the growth of the company. We pay 70% of our earnings as dividend, and we split that on a 1/3, 2/3 basis. And we expect that to continue. So if we just go to the next slide, Hannah, please, and just talk about the balance sheet. We've got a really robust balance sheet. Our net assets have increased just under 15%. The only real change on this balance sheet relates to the acquisition of 8am. So we always mention that we're capital light. We sit between the platform where the technology is, and that's where the technology spend is, with the platforms, and also with the IFAs, and that's where all the client relationships are. And Tatton sits in between those two positions in that supply chain, providing its service. So, like I say, the only real change is intangible assets, the 7 million acquisition price for 8am, and obviously the deferred element that is in non-current liabilities. We've got 21.6 million of cash on the balance sheet, which is a nice segue into the next slide. And you'll see that 21.6 is generated from cash from operations of 7.3 million. 5 million of dividends paid, which relates to the final dividend of March 22. Clearly, that will be lower in the second half of the year, about 2.7 million in relation to that 4.5p dividend. And then our normal tax payments on account, the acquisition-related costs, and that includes the underwrite of that share issue as well of 500,000. Clearly, that's not going to be there in the second half of the year, and you'll see the relatively modest amount of capex. So when you look to the second half of the year, you'll see a really strong cash performance from the group. Moving to the next slide and just take a little deeper dive in our divisional performance. Tatton's grown really strongly. As I said before, that 907 million of flows is a record. It averages about 150 million a month. So, look at the prior year as 652, where it's typically around 100 million a month, and even in H2 last year it was at a very similar level. So a significant increase in this first 6 months. The revenue of Tatton, obviously, as you can see, is 17% growth. We also got affected by the negative or the volatile markets and the negative market performance of 905 million in that same period. It's probably just worth pointing out that the timing of that was very unfortunate because markets were typically very bad in April, May and June, slightly recovered in July and August, and then also deteriorated again in September. And that's clearly within our first half of our year. If that markets had just been neutral, you'd have added 500,000 to that top line of revenue, and it's clearly 500,000 to operating profit, and you'd have seen growth north of 20% and margins north of 61% as well. Paradigm, clearly the growth in revenue and also operating profit not quite as strong as Tatton, but still, 8 and 7 and 7.8% is modest, but still very good. Clearly driven by those mortgage completions, and as Paul said, clearly in the second half of the year, we're not anticipating it to be as strong. And when you look at the cost base in each of those groups, it's broadly in line with what we anticipated as well. And then on the next slide, we have a bit of an outlook for you. So on the left-hand side of that slide, it kind of reiterates everything I've just talked about in terms of the first half of the year. And as we look at the second half, we're remaining cautiously optimistic. We're looking at 100 million per month or slightly north of that, for Tatton in terms of new flows. Obviously, the markets are baked in for H1, but to be honest, I've since recovered a little. We've probably got back about 400 million of that market deterioration. And then from a Paradigm perspective, the mortgage market does remain uncertain. That said, there are significant opportunities out there. Historically, we've grown from new firm growth. There's lots of 5-year mortgages that are now coming up back into the market. So there'll be lots of new remortgages and product transfers as well. And our consulting business, which is a compliance business, is obviously robustly consistent and not particularly driven by markets. And then from an inflationary standpoint, of course, inflation's here to remain, certainly for the second half of this year. We anticipate, increasing our salary increases probably broadly in line with the prior year. We had a bit of structural cost increase in our ACD cost, but that's relatively modest at about 200,000 per annum. So what we're actually giving guidance of is keeping our margin broadly to remain strong and just over that 50%, which is what we see this first half of the year.
Thank you, Paul. Hannah, if we could go to slide 18, that would be great, thank you. So looking at the roadmap to growth that we gave to the city around about 18 months ago now, we said we grow from 9 billion to 15. So where we sit as at November 2022, we're now at 12.9 or 65% of the target. So well on the way to the 15 billion. I think for us, it says that, we should get there with just pure organic growth that's expected to come through over that period, and that we don't necessarily need the help of any M&A activity to get to the 15 billion mark. That said, we'll continually look at the marketplace to see if there is any activity which we can add on, but we'll only do that, if we think it's complementary, takes us into a new group of IFAs, and obviously is earnings enhancing as well. So I think it's a lovely position to be in, that we don't necessarily need to have an M&A activity to get to the 15 billion mark. So it's a good slide that we're happy to continue to update. Next slide takes us through the 4 fundamentals, and really now looking to have a look at the recent set of reports which show the state of the nation with regard to DFM MPS. The platform report, which was issued in August 2022, calls the DFM MPS the fastest growing segment of the wealth management arena. And it's continued to, it's now sitting at 81.4 billion, and we've got 13.9% of that. But it is expected to continue to grow at a rate of 25% per annum to 200 billion over the next 4 years. We genuinely can see that happening, and we would obviously look to maintain our market share, and if at all possible, then look to extend it. But if we were to maintain our market share and it did go to 200 billion, then you're obviously looking at 27, 28 billion of AUM in 4 years' time, which would be fantastic. So, we're really pleased with the growing maturity of the MPS world. We've got lots of new entrants in there. We're still competing against the usual cohorts and the usual people. We're very happy with our price at 15 basis points. We see no pressure whatsoever into changing that, to reducing that. We're very happy with that 15 bips. Most people are coming down towards us in price. Some have gone underneath us and are offered a lower price, but we're not seeing them actually moving forward and being competitive currently in the marketplace, but obviously we'll keep a watchful brief on that. It isn't just about price, it's about long-term consistent investment returns. And, we're heading to our 10th anniversary in January next year. And we have delivered consistent long-term investment performance over that period, with our portfolios all performing nicely. We never want to shoot the lights out, but we're nice and consistent and steady, and we avoid any of the horror stories that might be out there. So added to the fact that we've got that widest breadth of IFA partnerships, as that we've talked about, we'll come back to later. I think our landscape is pretty strong, and when it comes to servicing our existing IFAs, we have a very, very strong culture and service. It's what we're all about, and it's something that from the top we lead with as much service support as we can for the IFA sector. We understand them, we champion the IFA sector on a daily basis, and I'm very pleased to say that the IFA sector continues to go from strength to strength, despite obviously the headwinds that are out there. So all good there. I'll touch on retention shortly. On slide 20, you can see how the assets have grown from 25 billion in DFM MPS in 2017 at the bottom to 81.4 now, and then obviously expected to go to 200 billion over the next 4 years. We still believe that IFAs love platforms, so platforms have grown from 450 to 680. It's going to be a higher number than that now, with the market recovering to some degree. And we expect that to go to roughly 1 trillion over the next 4 years, 4 or 5 years. So you can see that is growing. I think the interesting piece for me there is, even with the growth of the DFM MPS, it's only going up by one single percentage digit per annum, roughly. You've gone from 8.5 to 9.7 to 10.1, now to 12. It's still a long, long way to go. And obviously your next question would be, well, where's the rest of the assets sitting? And we believe it's in multi-asset, multi-manager, some still sitting in the IFA's own advisory models or their own funds of choice, and some in their own discretionary models as well. So there's plenty to go at, and we're hugely excited about the growth of the sector. So the next slide is really just to depict how over the period the flotation has worked for us. So when we floated in 2017, all of the support we had for the Tatton investment business was all from Paradigm firms, because obviously that's where we incubated the whole concept and built up the proposition. And then, of course, from 2017, we've been attracting or allowing other firms who are non-Paradigm firms to utilize the service. And we've been marketing hard to those firms. And as you can see, that's been very, very successful over the period, when you can see how the AUM now is in favor of the direct firms, which is incredible. And also, if you look at the number of firms supporting us, if you look to the far right there, the Pac-Man there is really squeezing the Paradigm firms further and further out, which is exactly what we wanted to see. We'll come on onto the next slide, which shows you the saturation or penetration levels that we've got to with both the Paradigm firms and the non-ones. This is an old slide which we continually update. We believe that on average each firm's got roughly 40 million that's addressable on platform. We've got 3/4 of that from the Paradigm firms now, because we've worked with them the longest, and we've got 1/4 of that from the non-Paradigm firms at 10 million per firm. So a simple bit of arithmetic says, if you could reach the same penetration or saturation level with the non-Paradigm firms as you have done with the Paradigm ones, you've got 12.4 billion of AUM that is addressable and could come to us over a period of time if we were to be as successful on the penetration side. Of course, the plan is to continue to build the number of firms supporting us up from the 8 or 7 that it is currently, but also, with our relationship management team, look to drive the non-Paradigm firms average higher than 10, and that's been going up gradually if you look back at the chart. So, that's a lovely position to be in. And then if we look to slide 23, we're looking at the strategic partnerships and who we're partnering with. So we believe that 50 to 60% of the IFAs out there partner with within the top 10 UK distributors. We would, as you can see in green, we're partnering with 6 of those now, which is pretty strong. The ones in red we just will never get to work with, because they have their own version of Tatton within their operation, so they're fully integrated machines. And then the amber ones are ones where we can, over time, look to build our relationship and get into true partnering if it's at all possible. Somebody like True Potential, of course, obviously offer their own services, and so do others, but they allow us to at least have a chance to get some business from them. So when you look at the strategic partnership arrangement, we've got plenty to go at. We've seen the returns that we've had from both the Paradigm and the Tenant, and now the Fintel one over the first 12 months. And of course, the sales teams are working to extend that out actively. We have 7 people in the sales team direct, so 1 sales director with 6 direct reports. And I'm happy to say that they're not running up to capacity; they can still take more leads. But of course, if we did want to extend and we saw the right individual, then we wouldn't hesitate to add that in. But we're very happy with the 6 that we've got, and then they've got relationship managers behind them, and also within Lothar and the team in the city, we have investment specialists that can actually come on and help the BDMs actually convert member firms across, and that works really, really well. So on slide 24, we're not resting on our laurels. This MPS world is definitely the place to be, but we've got to keep evolving it, and not every IFA wants to completely outsource a whole arrangement and their name just disappear completely out of the fund management proposition. So we have 3 different segments that are available to those firms. A firm can have a co-branded Tatton MPS, so we can be co-branded with that particular firm. We've got 9 arrangements there. We've got just short of 600 million that's come in from that. And that's really good. We're happy to do that. It doesn't cost us anything. It's still at 15 basis points. Costs us very little, if anything, to co-brand, but it gives that IFA a feeling of ownership, if you like, and glue, which maintains that the asset's even more sticky. You can move on to that to go completely white labeled, where the IFA has his own naming of the portfolios, and we drop out to become the Intel inside. We've got 6 arrangements like that, and we obviously want more, and that's totaling 612 AUM. And then we have 1 where we go a stage further, where the IFA was considering having its own discretionary fund management permissions with the regulator, but thought that was a step too far, but actually thought it'd be really good if they could join the investment committee. So we offer a joint investment committee with us having control. Nothing can be purchased within the portfolios without our approval. So we keep a watchful brief on that, but at least they feel part of the investment approach. And we can bespoke that to some degree for them. So that's how we've evolved. Slide 24 shows you the sort of landscape, if you like, and where we are. Sorry, 25, beg your pardon. Slide 25 shows you the landscape of who we are competing against. I mentioned earlier that there are lots of new entrants, but we do seem to be still competing against the names. I'm happy to say the brand's evolved and has grown. And we're getting our fair share, and we are invited to tender alongside some of these others on a regular basis, and we get lots of phone calls coming into the office to give new leads to the IFAs. On slide 26, we've shown our attrition rate because IFA consolidation is ongoing, and we've actually lose about 2% of our FUM to IFA consolidation. It's not a big number. It's something we should keep an eye on, a watchful brief, if you like. But there is a little bit of attrition, but I think there's good things and bad things from IFA consolidation. I think consolidation actually says to the IFA they're building valuable businesses. For every person that wants to sell, there's a person, an IFA who wants to buy and extend. We're looking to see how we can help them grow, because that's our job as an IFA support services business and a champion of the IFA sector. So it's not something we're concerned about, but something we actually keep an eye on, as I said. Slide 27 shows our strategic direction, which is very much organic and more organic. But obviously, working with more and more strategic partnerships as and when we can, and then a little bit of M&A if we can find one that suits. I have to say, with the sort of the growth of the MPS sector, or the maturity of the MPS sector, people's aspirations are a little bit higher on valuation, so we need to keep an eye on that. So as I say, mostly organic and maybe potentially with the odd bit of M&A moving forward. And then on slide 28, just to cover off Paradigm Consulting and Paradigm Mortgages, obviously the last 6 months have been really strong. We expect Paradigm Consulting just to be steady away with work done on consumer duty. And if we look at the mortgage division, obviously it is predicted that market will slow. Our MD believes it could slow to the rate of 10 to 20%. As I said earlier, it's 10% of our revenue, so that 10 or 20% drop in the market isn't going to push us away from our forecasts. And we also believe that mortgage advisors are super resilient and they're already turning their attention to product transfers. And there is a huge fixed rate maturity mountain that's coming over the hill, which people will be working with over the next 6 to 8 months. And obviously then we'll continue to build the number of firms in there to try and counterbalance any downside on the mortgage market. But we can't sit here and say that we don't expect it to come off to some degree. We do. But as I say, it won't push us off course. That, I think, takes me nicely over to Lothar to take you through the investment piece.
Thank you very much, Paul. Hello. Yes, my first slide, just to reiterate or refresh our 7 USPs. So we started out 10 years ago with that challenger proposition coming in at an unrivaled 1.15 DFM fee. As we heard from Paul, there's some others moving down there. And, in a way, it's still important, but other things have become just as important. So being on 20 platforms, therefore platform agnostic, is really important. The non-compete position that we have with advisors is very important for them compared to some of our competitors. We are a pure investment manager. We would never be able to take on a client directly, even if they wanted to. And the breadth of our offering means that they won't have the problem of being accused of shoehorning clients into something that might not be suitable. With the 45 model portfolios that we have on offer, we cover very, very broad, wide base. So, for example, the ethical portfolio approach is not something that we've just started when it became fashionable 2-3 years ago. We've been doing this for 7 years in the portfolio space and are therefore probably the longest ones to have done that, with the longest track record in the portfolio space. Client protection, well, we adopt the reliance on others approach, which means that it's not the IFA who's carrying the risk and signing up the clients as the agent as client approach has it. We have an individual investment management agreement with each and every underlying 100,000 accounts that we have, which obviously is comforting, more comforting for the IFA, because it is that classic relationship as you have it in the private banking space. And then last but not least, where it isn't the key skill of an IFA business to produce, we call them mail mergers, or sending out lots of letters to all their clients if they don't want to continue managing the portfolios themselves, but appoint us, then we help them with that bulk migration support. So next slide, a quick overview of our overall proposition. So on the right-hand side, bottom, obviously very important that the 20 platforms we're on. Above that, the risk profilers and being on there, which is so important for the IFAs in order to document the suitability of what they advise their clients on. And then the model portfolios there on the left, across 5 different styles and across 6 different risk profiles. So that's quite a comprehensive matrix there. And if that isn't enough, then we can also offer a sort of bespoke service, so particularly for clients who have, for historical reason, cherished holdings or need a specific pension drawdown arrangement. We can do that through our MPS-based bespoke service, so we call that the BPS service, and for IHT purposes, the Tatton name portfolio. Next slide, please. So this is how our assets under management spread across all the different categories, with the exception we haven't listed here, the BPS and AIM. But as you can see, where there's negative percentages doesn't mean that area is shrinking. Everything is growing, but it's just in the relative proportion of the overall 100, it may be going down. So we can see that the tracker and the hybrid of tracker and active are still the strongest growing, which is interesting really, because the actively stock selecting funds have had a major comeback this year in the market, as we've seen that massive rotation out of growth more towards core and value. And therefore, I think that's still a bit of remnant from the previous more momentum-driven fund performance era. We're also seeing good growth still in ethical, but that's come down, might be and may well be driven by there just being less of a performance advantage, because let's face it, ethical is a restricted investment universe, which very much has got a growth tilt, even though we've diversified that as much as we can, but the performance therefore this year there will have been lagging when it was massively ahead in the years before. And then last but not least, our Tatton Global that we introduced in 2020 is also picking up a fair share now. So it was right to have launched that. It does have a following in the UK with investors who want to be more globally focused rather than having the traditional sort of 30% of their equity exposure still in the UK. Next slide. So on the performance side, our 5 years there at the table, and on the right-hand side, we've just depicted the Tatton hybrid, which shows exactly where we want to be performance-wise, i.e. they are thereabouts where our peer group is, just sort of a smidgen better, recovering more of the cost that retail investors obviously incur through the whole value chain. Where we've got that one outlier there at the top, which normally we wouldn't like so much to have such an outlier, that's simply because our global equity portfolio is driven by a global cap-weighted allocation. So as I mentioned earlier, that only has 4% in the UK. With the US having been so strong over recent years, that's obviously produced a stronger performance than the average classic peer group in the UK. So on the next slide, we have got the 3 years, and there we're showing the whole range of the Tatton Ethical, and you can see that it's really carrying through in here with the global asset allocation. But again, we are very happy with where we are relative to our peers if you look at the table. And the same is also true, I haven't got it on here, but somebody mentioned yesterday about 1 year. The 1 year also looks really strong. The only one that we have slightly underperformed the ARC peers there is the defensive area, because we didn't hold quite as much cash as some of our competitors may have. So that's something to recover, and we're in the process of. So on the next slide, we are showing the communication is increasingly important and very much appreciated by advisors and clients alike, and so we're very much reacting to that and producing a video, educational or market update video more or less every week. And that's really been a very strong addition to our communication, which otherwise centers around the Tatton Weekly that goes out every Friday. And of late, obviously the ethical has been particularly important because there was so much debate and discussion in the press. And therefore, it's very, very close to our heart to make sure that investors who come in on our ethical portfolio do understand what you can, but also what you cannot promise from this sort of exposure, and doing that very much through the communication. Now, on the next slide, we don't tend to talk very much about the IT that we have got internally, but increasingly it is creating quite a strong additional proposition to our investment proposition, in that it makes it really a lot easier for the advisor to sign up clients that are on any of the 20 platforms, and then seeing them in a consolidated view through our portal, but also signing up new clients by generating very personalized investment proposals, which are usually only something that you would get in a bespoke or private client, private banking arrangement. So that's proven really, really valuable and also very safe. I mean, we have invested massive amounts of effort into making it as safe as possible from a cybersecurity point of view. So with two-factor authentication being the must. I'm feeling quite comfortable that we've done what's the top end of IT ability.
Thank you, Lothar. The final slide is just our summary slide, which we've been through. So I think, Hannah, we're probably ready for questions.
What was the reason for the drop in Paradigm firms from the peak of 182 in September 2020 to 168 now?
It's just a little bit of consolidation, I think. You've seen some firms retire, some being consolidated, nothing more than that.
What share of the overall platform market do you think MPS could reach? Is there a natural cap?
I don't think there's a natural cap as such, but as I say, we expect, I think we're happy with the forecast that they are saying we get to over the next 4 years of going to 200 billion. So that would probably be about 25% of the amount. But there's no reason why that couldn't continue from there. But obviously, it's hard to look further out than 4 years.
Thank you. Have you thought about offering your portfolios to fintech D2C companies which service consumers directly? And if not, might this be a future growth path to a younger client base?
It's a very good question. No, I mean, to be fair, we're very happy with being distributing our products or our service operation from and to the IFA sector. If you look at everything we do, we're very IFA centric. So, we have no thoughts to go direct to consumer. It's all B2B for us.
And what about your efforts to attract a younger client base?
Yeah, so really that's a job for the IFAs. So the IFAs are the ones who've got to make sure that they attract the younger members of the family. If you look at the average age of the IFA, it's roughly 56. And if you look at the average age of their clients, funnily enough, it's 56. So, they know that they have to improve and get to know the children who are moving forward into that space. So it's something that they are doing. Lots of IFA businesses are bringing their own family in to work within the practice because of the consolidation valuations that are there. So again, those will be working with the younger generation moving forward. And I think post-COVID, a lot of the IFAs are working pretty well digitally these days and have extended their footprint on the back of that. They're not just stuck looking after people in their own area. They can go out of area now, but they will definitely looking to engage with the next gen.
Thank you. Our research has forecast a drop in second half revenues compared to last year. Is this does your thinking align with this?
I think that just reflects the markets effectively. And I think what we were also saying was, first of all, we're seeing a sort of market recovery. But we're cautiously optimistic is the point we're making.
Thank you. As ever, are you seeing any pressure on your pricing power? Obviously, that nice graph you showed put you way ahead in terms of assets and the lowest on price. But are you seeing any to stay ahead of the crowd?
We're not seeing any pressure on price whatsoever. And we obviously ask ourselves all the time: is the price right? If we drop the price, would we get more? We don't think we would. We think price at 15 bips is the industry price that everybody will settle towards. Yes, there will always be an outlier, either up or down, but it's not something we are concerned about, and we're very, very happy maintaining the 15 bips.
Thank you. Can you give an update on the current growth trajectory of the Fintel and tenant deals?
Yeah, of course. On the tenant deals, obviously growing back a longer period, we're now in excess of £1 billion. I think we guided the market that we do 1.2 to 1.5. So we should easily do that and extend as we work with more and more of the tenant firms. And with Fintel, I think we could be looking in time to get to 1.5 billion, maybe over the next 3 to 4 years. We're already at 300. So, again, lots and lots of firms to go out there. And I think I'm happy with those numbers that we've given.
acquisition prices, there's more competition out there to acquire assets, operational leverage. Given your attractive margins, is there an argument for increasing your land grab at this stage?
That's again a very, very good question. I think, you know, we are on a land grab, so we're pushing hard to get as much new business organically as we can. Everybody's incentivized and pushing and pulling in the same direction. When you look at the maturity of the NPS world, as we've said, that naturally pushes up people's expectations of valuations. And we did lose a potential M&A target to another party recently because they were prepared to pay more than we were. So unfortunately, you get a push and pull, don't you, as things mature and the market goes as strong as it does, then people's expectations go higher and therefore pricing goes higher. So therefore we, as I said earlier, we don't need to do M&A. We'll only do it when we see that it fits and we can buy it at the right price.
Can you explain, and leading on, can you explain the rationale and potential of the 8am acquisition?
Yeah, the rationale first. So the rationale of the 8am one was, you know, they were a team that we knew, so we've known them for some time. It's a different way of managing the portfolios. It's very quant or AI driven. So it takes us into a whole new breed of or different IFA sector. So it's complementary. It's at the same price as us, so we can see that it's attractive from that point of view. So all in all, we quite like the structure of the deal, the fact that there was 50%, so it wasn't much of a risk proposition. We're not integrating it currently, we're just leaving it sitting as an outlier. We'll look to integrate later, probably when we buy the second half, when we get to that level. It's got an earn-out proposition as well, so they've got to perform, you know, to reach the earn-out proposition. We're very, very pleased with it to date. We expected, and I think we guided to, you know, getting 800 million. We're up to 1 billion now, and we look to see and help them move their flows forward and utilise, you know, some of the HQ stuff that we can give to them, such as the portal as Lothar's been through, and any support we can give them to help them grow faster.
What is the main glue in your IFA relationships?
I don't think there is one main glue. I think it's a number of things. So I call it 4 planks really. I think obviously price, the consistency of the investment returns, that's so vital. And then how you service and how you communicate with those IFAs. I put the 4 together. We really do understand what they want, and we have a tremendous culture within the business to support the IFA and service the IFA, you know, which goes back to one of the previous questions, you know, have you considered going direct to consumer? So, you know, we do understand where we sit. I don't think anybody serves the IFA community better than we do. And as I say, the culture is, you know, from the top right the way down, that when an IFA comes on board and they want us to jump, we usually say how high would be the concept there.
Good way to treat your clients.
Yeah.
What keeps you awake at night? Not
a lot these days, to be fair. I'm always tired. No, I've literally, there's nothing that we're concerned about. It's obviously a solid question. It's one that I would ask myself. But no, there's nothing that keeps us awake at night. I think for us, it's all about execution of the plan. It's about where we can take it. We can see that we are very fortunately in the right place in this super growing marketplace. And, you know, we just need to maintain that and move that forward. And we obviously enjoy doing what we're doing. And no, I have nothing that stops me sleeping at night.
Good. Well, that's it from the questions. You know, I think your performance, you could argue, has been super heroic. I'm sure that's what you were referencing with the picture behind you. But a few comments on that as well. So I think I appreciate that. But thank you all for that presentation, and we look forward to hearing from you in 6 months' time.
Thank you, Hannah.
Thank you,
everybody.
everybody.
Thanks a lot. All the best.
Bye-bye.
Thank you. Bye-bye.